You're listening to Seattle Real Estate Podcast.
Sky-high home prices may push Fannie Mae and Freddie Mac to back loans of nearly $1 million. If you don't follow the housing market, this might sound terribly boring, and why would you pay attention to this? Sean, that is the most boring topic of all time. Well, this is one of those factors that reflects the ever-increasing pricing in the housing market. Why are homes getting so expensive? Well, in this case, one of the things that we can point to in this little headline here, and I'll get to explaining Fannie Mae and Freddie Mac. Why do you care about them? Well, you do. That's the bottom line, all right? And why backing loans of $1 million? I don't care about that. I'm not going to buy a house for a long time. I'm never going to buy a house. All right, but if you're renting, you got to live somewhere. Why are home prices going to the moon, and how are they getting there? This is one of those components. Fannie Mae and Freddie Mac, they back loan limits. And so that means they're going to be pushing up the amounts at the most affordable levels to borrow on. They're going to be pushing up these amounts that they lend to home buyers based on how much home prices are appreciating. So the home market goes up, they increase their loan limits. If they cap their loan limits, then less people will be able to afford things, and arguably the market wouldn't move as fast as it has been. And also, fewer people would be able to afford these homes, meaning our appreciation might not be as great. We're going to get into all those factors. We're going to talk about it. But getting close to $1 million for a Fannie Mae or Freddie Mac home backed loan, that's some tippy top pricing. $1 million is a big, big number. And we haven't seen that yet. Obviously, this is the first time because that's where home prices are going. To the moon, it feels like, right? Especially if you've been doing this for as long as I have, back when Fannie Mae and Freddie Mac loan limits were, about 25% of that. I mean, market's it's really taken off. Before we jump on in, if you're new here, welcome. My name is Sean Reynolds. I own a couple of real estate companies, and I read the news from that perspective. So let's jump on in. So home prices all over the country have seen stratospheric increases within the past year as demand for homes spiked and inventory tanked. But higher prices are expected to push the limits of conforming loans to what experts anticipate may be record increases in 2022. Do you get tired of hearing about record increases? I do too. Yeah, you're like, when are we going to have normal again? Is anything ever going to be normal? With the maximum loan amount limit at nearly $1 million for high-cost areas, the expected increases were reported by the Wall Street Journal Tuesday, and industry publications have been forecasting the changes too. So what do we have here? We've got Fannie Mae and Freddie Mac are quasi-governmental entities. What they really do is they provide liquidity to the mortgage market. So if you go to a mortgage broker and he sets you up with a loan, he gets you a loan through, call it United Wholesale, a lending company who is a wholesale lender. He gets a loan through them. They are then in turn going to sell their loan to Fannie Mae or Freddie Mac, who's going to package it up and sell it to investors, right? So they're a kind of a pass-through entity. And what they do is they provide liquidity, meaning everybody knows there's going to be more money where that came from. And so what the consumer gets on the front end is the most reasonable pricing for a mortgage that they can get. Now, could they go to their own credit union? Could they go to their own bank? Yeah, you can. You can do that, but you might not get the best rate. You might not get the fewest amount of points that you're paying, a point being 1% of your loan amount. And, a mortgage broker oftentimes will be able to, a good mortgage broker will be able to find you the best deal for your scenario based on your income, your credit score, the amount of money you have for a down payment, all of those things. With what's going on with Fannie Mae and Freddie Mac is what we're saying is that, all right, we've got these conforming loan limits, which means the very best pricing goes to these conforming loan limits up to it. Say it's maybe it's 750 in a really high priced area, and it's based on the average price of homes in the area that the lending is being done. So, areas of California are going to have wildly different conforming loan limits than to say communities in Eastern Washington, here in Washington, and vice versa. Seattle is going to have different conforming loan limits than to down south in Southern Washington. And so when you've got increases happening in the real estate market in general, these conforming loan limits kind of get marched on up so that more people can afford to buy what's considered an average home in these markets. And now we're saying, hey, $1 million isn't that off of kind of the top end of an average home in the greater U.S. Market. And the Wall Street Journal was kind of the first one to really crunch the numbers and put an article out. That's the bottom line here. So that is a massive oversimplification that hopefully makes sense on what we're talking about. But when you go to get a loan, oftentimes, if you're talking about a conventional loan, you're talking about a loan that's going to be backed and purchased and investors involved on the very back end, something that you'll never see until you get a notification of, hey, you got to make out your mortgage payment to XYZ lender. And then you just do, and you don't even think about it. It means somebody bought your loan. You hear that term come up all the time. So we're at this point in the marketplace where we're going to hit $1 million for a conventional loan in some of these higher tiered markets. And that's just insane, because the amount of income it takes for, say, an average person, or calling these, we're calling this conforming lending. This is the top end of conforming lending. Is if you got $1 million loan, it's just a boatload, right? I mean, that's a technical term. It's a boatload. So it just means housing has become really, really expensive, especially in these communities where they're hitting $1 million for conforming loan limits. So mortgages above the conforming loan limits, what are those? Those are non-conforming. All right. What are those? Basically jumbo, meaning big. You got a big mortgage there. Mortgages above the conforming loan limits imposed by federal mortgage giants Fannie Mae and Freddie Mac are considered non-conforming, number one. Number two, jumbo mortgages. So you hear people talk about, I'm getting a jumbo mortgage. What does that mean? It just means that the mortgage you are getting is not conforming. It's non-conforming. It's so high. It's beyond that. You're going to pay maybe a little bit more in points. You're going to pay a little bit more in interest rate. Your down payment might look a little bit different. Any of those factors could be in there because you don't have the benefit of being within a conforming loan limit for the area of the home that you're buying in. And so you've got this jumbo product, and typically come with higher interest rates, is what the article is saying. The increase is great news for home buyers, especially those in high-cost areas who were being pushed into a jumbo mortgage, even for a modest home. That's what's happening here in Seattle. Even with your average home, median priced home at like $800,000, it's become nutty how expensive housing has gotten. And are incomes really keeping up that much? Those are questions I have. Not that I lose sleep over them, but I'm like, really? Are this many people making that much money? Well, I mean, the answer is, I guess so, because it's happening, right? There are so many benefits to having a conforming loan. Increasing the loan limits will be huge. Now, I see that in two different ways. Yes, it helps people get into homes, but my concern is these are homes they wouldn't have been able to really afford before. Should we be pushing them into higher and higher priced homes? We're reasonable here on the Seattle Real Estate Podcast, right? So that's one thing that we think about. The other thing we think about is, well, everything's gotten so effing expensive that, all right, we got to do something to help people get a home. So there's that. That's the other reasonable flip side is, all right, Fannie Mae and Freddie Mac, they're going to bump up these conforming loan limits. People are going to be able to get a home. They're going to bring in their down payment. The loan that they're left with, they're going to pay off over the course of the next 30 years. That's conforming loan limits. It means they got the best pricing possible for that loan, right? But some analysts are concerned that increasing the limits to nearly $1 million may mean the government is playing too big a role in supporting high housing prices. Because at some point in time, if you're looking in and you're going, all right, let's see, my two businesses are based on the real estate market. I want it to succeed. I don't want to go down in flames. Nobody does. But the flip side to that is, should we be supporting all of these things, interest rates, conforming loan limits, down payment requirements? You can analyze rent now for, like almost kind of like credit history with the borrower. Should we be enabling people to buy homes by doing all of these things? That's something that I think about too. I'm not necessarily saying it's either good or bad, but you can't see it from just one perspective, right? You got to be reasonable. You got to think about how all of this impacts things. So what are conforming loan limits? Freddie Mac and Fannie Mae, which back about half of all U.S. mortgages, are not lenders. They're liquidity entities, right? But they buy loans from lenders and sell them to investors. They buy and they sell. They create that stopgap in between. That makes these loans cheaper for lenders, the people bringing the loans to them, which in turn usually leads them to offer consumers lower interest rates, among other benefits. By categorizing higher balance loans as conforming, so what we're saying is that, all right, home prices have gone up to a certain level. And so these ones at the tippy top, the most expensive ones, those used to be jumbo, but now we're going to make them conforming again because we've raised those loan limits. That's the one thing, if you take away from today's podcast, that is what is happening. Tippy top ones used to be jumbo. Now they're going to be conforming. There you go. More home buyers can qualify for loans that are typically less expensive, require smaller down payments, because you need a bigger down payment to get a jumbo loan. And why is all of this? And also allow lower credit scores. So you can get a lower credit score on a non-conforming loan. What's the difference between conforming, not a non-conforming, a conforming loan? So what we're saying is that conforming, it's normal, right? Jumbo is bigger. It's bigger than the conforming loan. Why is that more expensive? Why do you have to have a bigger down payment? Why is the criteria different? Why are those loans harder to get? Because there's more risk involved to the lender. The lender is going, all right, this is more money than conforming, and Fannie Mae and Freddie Mac may not buy this loan. You're going to have to sell this loan off to a jumbo investor. All right, here's what their requirements are. Because you're borrowing more money, or there are criteria within your lending package. Every time you buy a house, your lending package consists of your income, your credit score, the amount of cash on hand, all that good stuff. And when you're buying something super expensive, the lender is like, all right, this is a little bit more risky than this other cookie cutter home that's in a conventional loan amount, that's in a conforming loan amount. We're going to charge you a little bit more because there's greater risk. And here's how much more we're going to charge you. So that's in a real nutshell, that's a lot of how that works. So the Federal Housing Finance Agency, the FHFA, which oversees the two mortgage giants, Fannie Mae and Freddie Mac, is expected to announce the new conforming loan limits at the end of November. I mean, I'm sure you're going to put that on your calendar, aren't you? You're going to chalk that up and go, all right, let's just see what those loan limits are for my area. What do we got going on here? Heard about this in the podcast. This is good stuff. No, it's just going to come out and you're not going to know it. And then when you go to get a loan, maybe you're going to go, oh, at least we're in conforming. Probably not even going to do that. You're going to have that talk with your lender. They're going to tell you, all right, here's the best deal for you. It's conforming. And you're going to go, I've heard that term somewhere before, but can't really remember what that is and whatever. Anyway, all right, can you get me this rate? Because my neighbor got this. That's what you're going to say, right? But the formula for boosting the limits each year looks at how much home prices have grown during the year. And in 2021, it's been a lot. The baseline conforming loan maximum is currently $548,000. That's the baseline. That doesn't consider homes in expensive areas. That ranges up to a top amount for conforming loans of $822,000. That's in high-cost areas like San Francisco and Silicon Valley, New York City, and most suburban counties surrounding it, and Washington, D.C., and its surrounding suburbs. Of the 3,000 counties in the U.S., there are roughly 100 that meet the highest cost threshold. They're the most expensive, in which 115% of the local median home value exceeds the baseline conforming loan limit. So what the Wall Street Journal did is they said, all right, here's our estimated values for these communities. What's 115% of that? All right, it's getting close to $1 million. And they ran a story on it, and that's what we're talking about, right? Conforming loan limits are adjusted each year to reflect the change in the average U.S. home price. The law establishes the maximum loan limit in high-cost areas as a multiple of the area's median home value, up to a maximum of 150% of the baseline loan limit. So that's the actual number Wall Street Journal used, not 115. It's one of those numbers. Last year, home prices increased 7.42% on average between the third quarters of 2019 and 2020, according to the House Price Index. As a result, the baseline maximum conforming loan limit in 2021 increased by the same amount. But this year, home prices are expected to have grown a lot more. 2021, we had some huge appreciation. The most recent numbers from the FHFA's House Price Index in August shows that prices were up 18.5% from a year ago. That's on average across the United States. Almost 20%. Enormous. That means you've got communities where it's 35% probably, maybe higher. By that measure, the baseline conforming loan limit would be roughly $650,000, and the loan limit in some high-cost areas at 150% of the baseline would be around $975,000. That's where we get almost $1 million. All right? So it's math. It's based on math. This is not anybody guessing stuff. Some lenders are getting ahead of the announcement and already adjusting what they are offering, including United Wholesale Mortgage and Homebridge Wholesale, which are increasing the maximum conforming loan limit to $625,000. They're just giving a bumpy bump on their own. We're gonna get out ahead of this, and here's our loan limits, $625,000. Here's our next section. It is a big bump. The median price of a home was $363,700 nationally in the third quarter, up 16% from a year ago. That's according to the NAR, National Association of Realtors. Home prices rose in nearly all 99% of the 183 markets tracked by the National Association of Realtors. So 99% of the 183 markets that they tracked, with double-digit price increases seen in 78% of the markets. So almost the entire market went up. And 8 out of 10 of them went up by double digits, 10% or more, right? These price jumps have made it harder to finance purchases for many home buyers. But does that mean that we somehow manipulate these numbers to get more buyers into the market? Kind of feels like that, right? And don't get me wrong. I own a couple of real estate companies. The more people buying and selling, yeah, you got it, right? And while Freddie Mac and Fannie Mae have expanded the mortgage underwriting process for first-time home buyers by including rental payments in the mortgage credit evaluation process, many other home buyers can benefit from the updated loan limits and buy more. Is that a good thing? That's always in the back of my head. That's like, should we be doing this? I don't know. It's a big bump, Cohen said, but it would make conforming loans possible for a lot of people who never had access before. Many people in New York City never had the opportunity to take advantage of the benefits of conforming loans. All right. Okay. Yeah, I struggle with that. In addition to requiring a lower down payment and lower credit scores, conforming loans allow for a higher debt-to-income ratio, parents as co-signers, and other benefits. And for the self-employed, conforming loans also allow more flexibility in income requirements because tax returns are looked at differently. This will be especially important next year for the many people who suffered as self-employed business people during the pandemic and saw their income restored in 2020. We had the massive gyrations. That's what it's saying. And so I think a lot of lenders are going to look at this and go, all right, yeah, that pandemic, we had that whole period. All right, can you support current income with your returns? If you can, then we're just going to kind of keep on going. If they want to buy in 2022, they can get a waiver to provide only the most recent year's tax return. That's kind of what we're talking about, right? Concerns about the loan limits. Not everyone is happy about the increasing limits expected for conforming loans. Approaching $1 million loan limit highlights the need for Congress and the administration to think hard about how much support taxpayers should provide the mortgage market, said Ed DeMarco, president of the Housing Policy Council, an industry group focused on housing finance. He said that as home prices are rising faster than incomes, rising loan limits allow taxpayers to back mortgages to higher income households. All right. So it's not like we are allowing the entry-level home buyer into the process. No, we're allowing folks that are on the higher end of things in higher end neighborhoods to buy a house with big mortgages. I mean, if you're getting a mortgage at $975,000, you've got a lot of income to support that mortgage, period, right? Because otherwise, if you're getting a loan for $250,000, you don't need as much income. You're not at that same income bracket as the $975,000 loan, somebody buying a home with a mortgage of that size. So we are allowing higher end folks to get into even higher end housing. That's the bottom line. Some might say, but yeah, your average home in these markets is $800,000. That doesn't mean that the average income has gone up by that percentage. It hasn't. It's just the housing prices have. So you're wedging in people into a marketplace that arguably, well, maybe they'd make a different decision if they knew that they weren't going to get the premium pricing of a conforming loan. Would that slow the market down a little bit? Maybe it would. I don't know. Those are the things that real estate people do stay awake at night. Oh, what's the conforming loan limit's going to be this year? Gosh, I really wish I knew. Man, I can't sleep. I'm so excited for those numbers to come out. Said no real estate guy or gal ever. Taxpayer backing of mortgage securities results in slightly lower mortgage rates, he said. This encourages people to buy more expensive homes, and it feeds the run-up in house prices, exacerbating the affordability challenges we face in today's supply-constrained marketplace. That's probably the one sentence that makes as much sense as anything here, right? So we're getting people in because things have gotten so damn expensive and it's causing this run up, and we wonder why affordability is still an issue because we kind of keep throwing a little bit of gas on that fire and wondering why the flames just why does it keep getting bigger? I don't get it. What is going on here? While the increase in the loan limits happens automatically based on a formula, the FHFA has the discretion to put in place a smaller increase or even to freeze or reduce the limit, DeMarco said. Providing such mortgages with government-backed financing drives up house prices and crowds out private financing, he said. Okay, the crowds out private financing. All right, how many homes get purchased with private financing in today's market? Is that a thing? Well, I'm not going to get into it, but bottom line is people are going to be able to afford more house because it's going to be slightly less expensive to get that more expensive home, if that makes any sense at all, which the housing market in Seattle does not. But I talk about that all the time. And that's what we kind of analyze is why things are going just nutty here. And it's not just Seattle. It's all these markets across the United States. And these Fannie Mae and Freddie Mac increases, they happen on a city-by-city basis, obviously. And so if you're in an area that is more affordable, your conforming loan limits are going to be much, much less than, say, New York or, San Francisco or California, somewhere in California where we've got just crazy expensive homes. So this is just one of those little things that is out there that is happening in the mortgage market, which impacts real estate in general. And I kind of wanted to give you a run through and a rundown on that. I know we're not talking about Antifa. We're not talking about how Seattle is just terrible and, maybe the double-decker RV. We're not talking about the lawnmower man, Charles, here in Seattle, who's got lawnmowers lined up on the sidewalks and he's refusing to go into housing. We're not talking about that stuff. This is one of those things where if you can kind of wrap your head around a little bit of it, you understand that there's so many different components that go into the housing market. And if you're able to get a little bit of a mental grasp of what's going on, you'll follow these little bits and pieces and go, oh yeah, conforming loan limits, those got increased. Interesting. So people can buy more. Is that good? Well, I guess we'll see on the other side when the market finally slows down. When's that going to be? Man, who knows? That's the question of the hour, isn't it? We have another year of this? Sure feels like it, right? Oh, it does. And I'm a real estate guy. I should be going, yes, we've got at least one more year left to go. But it's pricing so many people out of the market. That's what's making me nervous. And then we've got things like this that just squeeze more people into the market and buy more homes. And yeah, we're on that hamster wheel of, market's just going nutty. Well, we've been doing that for a while. Any which way, I will cover what happens when these loan limits come out, if they are just off the charts nutty. If they're not, talk to your mortgage guy. He or she knows way more about this than I do. I know enough to be dangerous. Don't take my financial advice. Certainly don't go out and get a mortgage based on my financial advice. Yeah, there you go. Thanks for being here. Thanks for being a part of the Seattle Real Estate Podcast. We'll catch up soon. Doing another one willy-nilly. We'll talk then. Bye for now. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.